My name is Alex Sadolf,
And I'm Brandon Cobb.
and this is the Land Development Accelerator.
Into the land development space, I believe in anticipation of kind of what's about to come. So I'm gonna jump into Alice's strategy a little bit today, why they're getting into this space and tell them a little about it. But before we have the fun stuff, Alice, why don't you introduce yourself and tell everybody your story and your background, a little bit about Pinder Hastings Fund.
Sure. Yeah. So thanks for having me. It's a pleasure to speak with you guys. I think it's a great time to be in this exact asset class and space. So I will be talking about private equity, intersection of that, and land development. So a little bit about myself. So I'm Canadian. I am based in the Bay Area in California since COVID. So I came here to join my partner who's based here. So um, my background is actually corporate law. So, in my 20s, I practiced at a large national law firm in Canada, McCarthy Tétrault, uh, number one law firm, practicing securities, offerings, mergers, acquisitions. I think back in the day, that was about 18, 19 years ago now, if you can believe it.
Wow.
So, yeah, so back in the day, I worked on the IPO of Lululemon, a lot of the securities offerings, equity offerings, mostly equity financings for like forestry companies, mining companies, being that we're based in British Columbia. That's our industries. And so I went to law school because I have Asian parents that expected me to do well in school and then go on to attend some type of professional school. I couldn't get organic chemistry, so couldn't get into med school. And so law school was kind of the plan B. But I went, I really enjoyed it. I loved being analytical. Like I'm able to kind of digest a vast amount of information, synthesize, and I love negotiating and pitching deals for a living. So I think it was a really good fit. But while I was practicing corporate law, I always felt like the business people were actually having the most fun. I was just the person papering the deals, but I want to be the deal maker. And so that,
Yeah.
yeah, was kind of the reason why I left law after 3 years of practice and went into business. So 16 years ago, I went into my first business in international trade. And then from there, I went back into M&A. I had an M&A advisory firm that was then, very specialized firm that was acquired by PricewaterhouseCoopers, international accounting firm, Vancouver office, hung out there for a couple years, ended up hanging out with the people that were running the family office division. So got into, the family office work, convinced a couple of the next generation leaders of that practice to lead the mothership. So we broke away and went into starting a multi-family office. Right. So, managing families that have at least 30 million plus of asset. And then from there, throughout my own kind of business career, entrepreneurial endeavors, I was able to co-found, exit a couple businesses. So then I had my own capital. So I started to invest. So 12 years ago, I met my mentor in finance, James, who is now actually the other GP in our fund. So he's my business partner now. But back in the day, I was an early investor in his fund. And I said, I'm willing to support your fund, but teach me everything about private equity. So he did. And then I spent a couple years actually raising funds for what he was doing. We did very well. I did very well with my investment. So then went on to actually learn from other fund managers and eventually became a fund of funds manager in Canada, aggregating the best real estate funds in Canada. And so I just really enjoyed passive investing. I know you can make money in real estate 10 million ways. There's all kinds of ways to make money in real estate under the sun. It's a great asset class. I'm going to show you a pie chart in a second that is going to tell you what the people they're in the high net worth bracket, the Tiger 21 members are investing. But real estate, is still one of the best asset classes, if not the best. So I think everyone on this call should be happy to hear that you're doing the right thing. So yeah,
So
go
go
ahead.
ahead.
Yeah, so I was just saying that. So the reason why we ended up starting the land development fund is that, as a private equity firm, we're really looking for problems that are big enough that we can solve over time. So we don't want to do something that's just hyped up for a year or two, because you're actually putting a lot of bandwidth, time, manpower into a thesis. So when we are looking for a thesis to really focus on, we want to find something that we can work on ideally for 5, 10 years, if not more. And
Yeah.
so we actually took the time, like we're a Vancouver, BC based firm, Pinder Hastings Capital. So real estate is a very hyper local thing, right? So one thesis that, a thesis that works for one specific market, it doesn't necessarily translate. So what works for Vancouver, which we have 6 funds in Vancouver, focus on multiplex. So that is basically a fund that focuses on the exercise of converting single family homes into a 5-plex or 6-plex, right? So Vancouver being an urban center that has limited land to build on, that is the right thesis. So, with that being our background, like what makes sense there doesn't actually translate in the US. So in the US, for example, we looked at everything. We looked at like James looked at multifamily value add. Like I think he spent a year in Dallas in 2022. And then towards the end of the 2022, he saw the rate started to hike up, and so saw the writing on the wall. So luckily, we didn't actually go in and form a fund based on that thesis. So then we looked at building single family homes and BTR in Florida, um, I think in 2024, but then the hurricanes came and then the insurance rates, got jacked up. So there's a lot of environmental factors that kind of determine a private equity fund's direction. So eventually we actually landed on land development because we are very bullish on home building. And apparently Warren Buffett is too, because recently he just invested 800 million into Lennar. He invested, I think, close to 200 million into DR Horton. And this was like his big, one of his major kind of headline news in August. So just a couple weeks ago, he invested 800 million Lennar. So we continue to be very bullish on land development, which is the precursor for home building. And so that's what we focus on today.
Yeah, the thesis is very important, right? That's the foundation that a lot of these big private equity groups use before they go into something. Take us back to the inception of this spinoff for your firm, because a lot of them are diversifying, right? Peter Hastings funds, they're not just doing land development, right? Like they've got these buckets and they're allocating capital to the different buckets. Take me back to the inception of the land entitlement and land development fund. Like, why did you guys want to create a spinoff for this? You mentioned you're paying attention to large problems and moving capital into those, and they've got to be a long-term problem.
Those
You mentioned
documents,
five
yeah.
to 10 years. Would love to understand where this thesis was created and what was the motivation behind it.
Yes. So we looked at everything, as I said, and we wanted to find something that is going to be a persistent problem, if you will, that's going to be a thing we can solve for the next 5, 10, 20 years. So we study data. So we're a very kind of data driven, market driven firm. We are not people that, like, how some real estate investors, they get attached to their properties, like they like to see it, they like to touch it, they like it to be in their neighborhood, in their town. So we're not that. Like we look at the data first and foremost, right? So what I'm showing you guys, this is an organization called Tiger 21. It's a mastermind. So the people in this organization, so James was part of this organization for a decade or so. So we have some insights into it. So you got to have a 20 million liquidity or investable asset base to join. So this is what they publish every quarter. They poll their members. I think it's about 2,000 members globally, mostly people in the US, in Canada, as well as the UK. I think they're now, in Dubai and some other places. But it's interesting to see what people are investing in, right? So clearly these people, in these higher net worth brackets, they're investing a certain way that's different than someone that's worth, I don't know, in different brackets. So one good thing is that you can see that real estate it's very consistent. It's always about 25 to 28%. So it's always like a major asset class. And of course, public equities, most people are in stocks and bonds. And private equity is actually now, the number one asset class, a little bit more than real estate. So what we do, we're right in the middle. We're in the intersection of real estate and private equity. So we structure real estate related businesses into a private equity fund. So the format is a private equity fund, but the thesis is related to real estate. So I just wanted to show this to you guys to show you that this is kind of the genesis. Like back in the day, I said that 12 years ago when I first met James, he was starting his first private equity fund. And that was a traditional private equity fund, meaning you're buying businesses. So typically, private equity fund buys a business that is a boring gadget factory of some sort. So you're manufacturing, I don't know, HVAC equipment, turbines, or something like super boring. You want it to be boring because you want it to be as stable as collecting rent, right? So you're basically investing into manufacturing systems that pump out cash flow. So there's a term called quality of earnings. You want to look for companies that have very solid quality of earnings. So stabilized cash flow, recurring cash flow. So those are the darlings of private equity, right? And then depending on your size, like if you're a smaller private equity firm, you buy a small cap. Maybe you grow into a mid cap acquisition vehicle. If you're BlackRock, you're Blackstone, okay, well then you own everything, right? So I mean, at this point, private equity probably owns everything we see from what we eat, pretty sure whatever big brands of fast foods that is not public company, they're owned by private equity. Or even if they're a public company, they could be owned by private equity firm, shopping malls, apartment buildings, office buildings. I would say you'd be surprised. Like most of the things that we see that's in our lives is owned by private equity. So for us, we're an emerging private equity firm in the United States. So we wanted to set up a fund that's focused on a thesis that is in the blue ocean. So you know the concept of blue ocean and red ocean. So red ocean would be, it's basically a nicer way of saying it's a bloodbath, right? So if you go to multifamily, I feel like during COVID, everyone and their neighbor started to syndicate multifamily deal. That is a red ocean, very deep red, right? So a blue ocean is where you're looking for openings in an asset class where not many people have noticed it, or maybe they've noticed it, but they don't have a way of having an advantage over you. So you want something where you can go in, it's a hard problem to solve. It's hard enough that you can solve it for a long time. But it's not so big that you're ending up competing with the major private equity firms, because you can't, right? Like we can't compete with the BlackRocks of the world, right? The Vanguards of the world. So we have to look for thesis that is big enough and yet not too big. So you also want to look for places where there's barriers to entry. So for us, it's a bit of a serendipity, because I think we were looking at things and different potential thesis to go into. I ended up going to a real estate conference about a year and a half ago, and I actually met a land developer. And so he then, showed me what they're doing in horizontal development. And I was a little bit like, wow, that's unheard of. So, the thesis is so big because in America, there's a current deficit of 4.8 million single family homes. That's in deficit, right? That's the deficit from the last financial crisis. So the deficit continues to grow. But to give you a sense of scale, 4.8 million homes. Look at DR Horton, America's #1 builder, $35 billion annual revenue. So take a guess, like how many homes do you think they can build in a year at their max capacity?
Oh my gosh, I've never thought of this before, but 35 billion dollars. I'm gonna pull my calculator out. I'm gonna cheat a little bit. If they're doing $35 billion in revenue, then I'm gonna divide that by a $350,000 house. They're able to build 1 million homes a year.
That would be my guess, Brendan, but no, they build about 90,000 to 100,000.
Oh my gosh.
Yeah, and Lennar being #2, they dropped down to 70,000. Pulte would be the third place. They dropped down to 50. And then, in the top 10, we're talking about number 8, 9, 10 in the 20,000 range. So I was shocked that DR Horton at their scale couldn't produce 1 million homes a year. So
Yeah.
that
And that's today. That's like if
today.
you
Yeah.
had 5 million homes
Yes.
here out of nowhere. That, I mean, just and think about that for a second. You have to get the land approved for development. That's a year or two. Then you have to develop the land. That takes a year. Then you have to build the houses. That takes a lot. So it takes a long time for this
Absolutely.
inventory to actually hit the market. And it all starts with the land.
Yes, exactly. So having buildable land or finished lots, that is a requirement before the home builders can come in and build vertically, right, into houses. So one question I had in the beginning of this journey was, well, why wouldn't they just do that themselves? They're a multi-billion dollar company. So the interesting answer is that because they're a public company, while you're doing land entitlement or horizontal development being, building infrastructure on the land, building roads, you have to own the land, but ownership of land actually shows up as a liability on your balance sheet. So if you have huge liability on your balance sheet, it doesn't bode well for your stock price and so on and so forth. So they don't like to do that. They outsource that. They outsource that to very seasoned and skilled operators in land development. There're just not that many of them. Like I've done the research, like we've scoured, nationally because we want good operating partners. We don't actually do the land development ourselves. We are finance people looking at numbers and pushing papers, making money by pushing papers. We don't actually do the hard work. So there's actually just not too many players in this space. So it's a wonderful space if people have the ability to do the actual like horizontal development, for example, or have the paperwork skills or skills to deal with municipal politics and be able to do the entitlement process. So both areas, there are people that are very skilled, very specialized, like very seasoned and making a lot of money. And so for us, we realized that when you're in horizontal development as a scaled operator that has a good reputation, then all these national home builders will pay you. They will say, hey, Mr. Horizontal developer, we have this entitled piece of land. We want to build a master plan community of 2,000 homes. Can you do the horizontal development for us? We're going to sell it to you per lot, let's say $30,000 per lot. But once you're done your job, we're going to buy it back from you at $70,000 per lot. So you do your job over the next 2 years, 4 years of time. I mean, it depends on the project size. And while you're doing that, we also will pay you a deposit. So typical deposit by the home builder would be about no less than 10 to 15%. Sometimes it goes up to 25%. They have a takedown schedule. So as the project builds, every 50 lots, every 100 lots, they got to pay the deposit into the project. So not only does the horizontal developer have the signed contract with the home builder, right? They know the delta at the beginning. They know by doing this work how much they're going to be paid once they're done. I mean, I have been in business for 16 years now. I have not seen a model where you have an exit that's built in and contracted at the outset. That's insane. That's just like, I feel like it's the best kept secret in real estate. So when
The
we realized,
deposit can almost knock it. Like some of these deposits we get are like 20 of 30% of the total cost of the project. You're giving the deposit based on the purchase price, not the cost. And you're like, why? And it's free money for the developer to use how they need it to, no interest on it. I mean, it helps out significantly with the holding costs.
yes, absolutely. So going back to why we chose this thesis, we looked at the capital stack, right? So in a land development project, I'm talking about horizontal development. It's typically 75% from acquisition development loan, right? So 75% of debt, and then the next 10 to 15% comes from that deposit from the home builder. And then you have the equity slice. But the equity layer is so small, but your return is so big. So that's why it's such a perfect combo for a fund. That is, what's a fund supposed to do? It's supposed to pick the right project, do proper due diligence, and return maximum return for the LPs, the limited partners, the investors. So that's why we felt like, wow, this is something that no one's really doing. There are some land banking funds out there. There's a couple funds that focuses on land entitlement. It's different. No one's really focused on horizontal development. So for us,
Yeah.
we have good partners that is only focused on entitlement. I mean, we talked to one of your Greg, one of your good friends, last time when we met with Susan on the call. But for us, we like horizontal development projects because the home builder signs the contract as at the outset. You know the delta, you know the timeline, everything's kind of mapped out at the beginning. So it's advantageous to us as a fund manager.
So what she just said, I'm gonna try to simplify this a little bit because she did a wonderful job of giving a lot of detail. Success in any industry, especially when you're just placing capital, it's skating to where the puck is going, not where the puck is, right? That famous Wayne Gretzky quote. So she just told you the Tiger 21 survey. 50% of that was real estate and private equity. 28% for private equity, 25% real estate. He's bridging the two, going, oh wow, I can go after 50% of the wealthiest peoples in the nation's allocation and create a product that they want to invest in if I can make it real estate and I can make it private equity. Okay, so that's where the money is, that's where the money's going. So then she's like, okay, what's the blue ocean here? Where is the opportunity? Obviously, we're 4.8 million homes short. Who are the biggest builders? DR Horton, they're only putting out 100,000 homes a year. Lennar second at 80,000 homes a year. It takes 3 years to get product on the ground, from contract to entitlements to development to actual vertical construction. Wow, we have a significant supply constraint, and there is a constraint on the time it takes to get that supply to the market. Interesting. And then she's just paying attention to how many people are doing this. Okay, what are the terms of getting into this type of deal? Wow, the builder's going to put a 10 to 25, I've never gotten a 25% deposit, but I'm push for it. 10 to 25% deposit from their builder partners, and covers most of the gap between what the debt will provide and the capital needed to finish that deal. Wow, these are very attractive terms here. And we know that these builders need to buy stuff, right? It's Wall Street. Publicly traded companies, they have to buy land, they have to build. Otherwise, give us what's the nuance between debt and private equity? I think there's an important distinguishing factor there.
Debt, you cut out for a sec. Debt and private equity.
Yeah, what are some of the nuances between a private equity company like yourself and a lender that lends?
Right. So the biggest thing is that when you're lending money, you typically will take you will collateralize on the property, right? So we're talking about in real estate. So typically there's collateral involved. But a private equity firm typically, like at the beginning, like traditional private equity, we're talking about investing into cash flow. So investing into equity, but equity, there's no collateralization. So whether you make like the ability to make money from private equity comes from deep analysis. You have to know your due diligence. You have to know your numbers. You have to understand, the risk, right? So risk assessment is very important. Like the people that do debt, most of the risk is, of course, they also do underwriting and they assess the risk, but because they have that collateralization, it's just a different beast. Like the two things it's apples and oranges. It's very different. Like people that are very used to investing in private lending, for example, hard money lending, they most likely they don't typically touch the private equity and vice versa. So it's different, apples and oranges.
Yeah. The way I like to simplify it in terms that a lot of people understand and can compare to, like if I go to buy a home, I'm going to put a deposit down to buy that home. That's my down payment. And I'm going to get a mortgage from a bank. Bank is the lender on the deal. Let's say I don't have a deposit, and I call my buddy up and I say, hey Alex, I need a $50,000 deposit in order to buy this house. Can you want to be my private equity partner in the deal? I'll give you 50% of the profit that we make on this house." And he goes, "Sure, I'll give you $50,000." So he's putting his 50 grand in the house, and let's say that the value of that house goes up by $50,000, and we turn around and we sell it. Well, see the 50-50 partner, he gets half of that $50,000 upside. So he can make $25,000 on his $50,000 investment. That's why people are in private equity. Those crazy good returns because they're an equity partner. They're not the bank. They're not the debt on the deal. So important distinguishing, big difference there.
Yeah.
On this particular type of asset class, what does y'all's capital structure usually look like when y'all are partnering with local operators and people that you're doing deals with? Because y'all just want to be the capital piece. Y'all do not want to, if the person you're partnering with can't find, manage, and sell that deal and bring all the relationships and the expertise to it, like y'all are not interested. Y'all just want to be the money piece
Yes.
of the deal. What does the capital stack usually look like, and profit split on a typical deal?
Yeah, so we never we never invest in deals that do not actually have that forward purchase contract. So it's very important for us as a fund. We are responsible for maximizing the returns and kind of sorting the safety of the people that entrusted their investment in capital with us. So it's very important for us to check these boxes before we deploy the capital. So that said, when we invest in a land operator's project, we are their LP, limited partner. So that's a generic term for the investor. We're the investor. And typically we look for developers, land developers that give a very high pref. So it could be anywhere from like 20% to 30% pref. So does everyone understand pref equity, the concept pref equity?
Yeah, preferred return essentially. So that's where as the deal sells, they have to fill up that bucket first. So you guys got to get back your initial capital first, and then you've got to get a certain return on that capital, call it 10, 20, 30% or whatever. And then the operator can start getting a piece of the profits. It's
Yeah.
essentially like a waterfall structure where the waterfall's following into your principal bucket first. Hey, profits coming in. I need to get my money back first. Great, I got my money back. Now I need to get my 20% pref. So I need to make 20% of my money. Great, that bucket's filled up. Now the operator can essentially start participating in the profit of the deal.
Yes. Yeah. Perfect. Yeah. Well said. Yeah. So for us, we look for a minimum pref return of 20. So sometimes they go as high as 30. And then beyond that, depending on how much we deployed into the equity piece, let's say if a project requires a certain amount of equity and we take 100% of that, we typically won't just because of risk diversifications. We don't want to be the only money in a deal or the first money in the deal. But let's say if we typically have a deal with them where we will share a split out of the developer's profit. So if we take the whole equity piece, typically we can share as high as like 1/3. And then it's prorated, right? So if we don't go in completely, we do half, then we would get 15% of the developer's profit. So these deals are typically quite profitable. So imagine if it's, I think in really good cases, like 30% pref plus the developer's profit, it makes a very solid fund return.
Let's focus on just doing the entitlement stuff too, because I know y'all invest in entitlement projects as well that are very profitable. What do you want to see in a good entitlement project? Or I'm going to flip, what do you need to see in order for you to say, "Oh, wow, this looks like a great entitlement project to invest in. We want to take a closer look at this."
Yeah, so we typically will only look at entitlement projects where the entitlement specialist does not actually buy the land upfront. So they take control of the land, right? So by optioning, to get entry into an option to tie up the land. And then we look for evidence of local expertise because it's a very kind of local politics driven process. So they need to demonstrate that they have done this in that locale, in that municipality or county. They know how to work with the system over there, they can get it passed. So track record is very important. And then typically, let's say if all those conditions are met, then we look at, potential returns. But more importantly, it's more of a risk management measure of wanting to see that they tied up the land. They will work on the entitlement. Hopefully, the entitlement process is short rather than long, right? So no more than 2 years. 2 years would be kind of the maximum amount of time we would invest into any project, whether it's entitlement or horizontal development. So ideally, it's a short-term process, and then we want them to do a simultaneous closing. So on the same day they sell it to a home builder, they then close on their purchase. So again, it's the evidence of this delta. So we're looking for evidence and demonstrate a track record where they can show us that this is just going to be kind of business as usual. We're going to execute on this typical sequence of events, and then we can get it done. So not a lot of variable factors or unforeseen issues that could pop up.
And at what part of the entitlement process do you guys typically get involved? Because like you said, you don't buy the land, right? For entitlements, that's a lot of risk there. That's one thing we talk about that you mentioned, optioning it, controlling it, only purchasing it or double closing on it. After you've got all your approvals in place, having your builder lined up. You mentioned the double close means you've already got your buyer lined up and locked in before you do all the work and spend all the money and take the risk of getting it approved. Where do you guys typically enter into these projects if they've got the localized experience? Where do you want to see the project before you guys will get involved? I'm assuming that you've got some type of in contract or an LOI in place with your end buyer. They've probably gotten some kind of verbals from the city. Maybe it's a tentative map or preliminary plat approval, something like that. Do they need to have the endangered species reports, the geotags, the phase one environmentals done? Tell us a little bit about what you want to see on an entitlement project.
Yeah, so I mean, you said it very well. So it's a little bit case by case. So it depends on who is working on the deal and then where they're working on the deal. So we don't have like a specific line drawn in the sand, but it's a little bit more case by case. But we are looking for, the evidence that this will actually get through, and they have, you know, like they have the contract with the home buyer in the home builder at the end, so the end buyer is secured. And then we typically won't come in super early, so it will typically be when the project is underway and we're seeing like a really good progress, and we're seeing high evidence that is going to go through.
Yeah, it sounds like once you get past that tentative map or that
Yeah.
preliminary plat approval, the city's like, okay, like we've approved it. Let's go. We want this. You just need to design it at that point. You've got your contract with your builder in place. You've done some studies from the civil engineer to see like, hey, there's nothing crazy on here. It's not a toxic nuclear dump site or anything like
Yes.
that. And you guys are like, okay, got it. Now it makes a lot of sense. Are there any specific types of products that you guys are more bullish on in land development right now? And when I say products, is that like townhouses, condos, single family units, and then price ranges, because it can go all the way from affordable entry level housing all the way up to $4 or $5 million homes.
Yes. Um, the default model is that because we work with, we invest in projects where the land developer is working with national home builders. It really depends on the trends of the national home builders, right? So a lot of them are building, for example, affordable entry level
Yeah,
homes.
yeah.
Some, right? So 250,000 to 450,000. So typically for really large communities, that's the price point. So then it's not so much that we have a preference for any specific kind of price range of the homes that get developed, and we only uh, invest in projects that develop single family homes. So at this point, not condos, not apartment buildings, because these can be built quickly, and it just squarely fits into our business model. But occasionally we will see deals that are, um, up, sort of upmarket, right? So move up homes. So right now we are actually looking at deploying into a project that's in Florida, between Tampa and Orlando. And these are homes that's going to be at 1.5 million to $2 million, because it's around the lake. So that is something that we will also consider. But we also consider that because that project is a very fast turnaround. It's only 45 units, 45 homes. So it's a fast turnaround. We like that for our investors because investors like fast distributions. I mean, we all like that. So we also, so every time it's a case by case. We're not fixated on specific price point, but we do what makes sense in that market cycle.
How do you guys mitigate the risks on the projects that y'all are investing in? Because I know that you place a lot of emphasis on the operator and experience, and you guys aren't involved. Like I see a lot of private equity firms, they bring the money, but they also want to control the deal, and kind of manage the deal. We had somebody on last week that kind of did that. Like, they want to run the show, like their money, they'll partner with you, but like they control everything. You guys are different. Y'all are a limited partner in the deal. Y'all are the capital piece, and you're not controlling everything, right? So that's a big, big difference. So how do you mitigate those risks?
So again, I think from our perspective, even though we would be hearing from the land developer, but we do our own market research on the location, market adoption data. We do deep due diligence on financial models, right? So really dig into the pro forma, have a lot of conversations, to really comb through to really comb through the numbers, in a lot of detail. We look at legal documents. So we want to make sure that all the I's are dotted and all the T's are crossed. So a lot of like checking of legal documents and triangulation verification of these types of documents. And we also will go on site to do on site due diligence. So that's something that my business partner, James, who is a CPA for 24 years and came from audit accounting practice, he will actually like physically go to the site